Buenos días a todos, es un placer darle la bienvenida a este webinar Elecciones 2024, aprendizajes y perspectivas desde el 5 de noviembre. En nombre de nuestro presidente Sergio Lucas y de la Junta Directiva agradecemos sinceramente su presencia en este webinar de gran relevancia. Como sabemos, las elecciones de Estados Unidos impactan no solo su política interna, sino también las dinámicas internacionales, especialmente a América Latina, y las decisiones en Washington afectan directamente las relaciones diplomáticas, económicas y sociales con nuestra región. Hoy nos acompaña Larry Mcdonald, autor del gran éxito del New York Times, colaborador del CNBC y experto en riesgo político, creador de A Bear Traps Report, una plataforma de investigación de inversiones independiente centrada en el riesgo político y sistema global con ideas comerciales prácticas, creador del libro When Market Speak, con revelaciones asombrosas y aderezadas con indicadores de riesgo prácticos, lecciones de gestión de riesgo y salpicadas de humor. Larry nos compartirá hoy su análisis sobre los posibles escenarios postelectorales y sus efectos en nuestra región. Al final de la presentación los invitamos a participar. Pueden abrir su micrófono para preguntas y respuestas y este evento está siendo grabado y va a estar disponible para su revisión futura. Así que sin más preámbulo, les doy la palabra a Larry para dar inicio a su presentación y nuevamente gracias por acompañarnos. Así que pues comencemos.
Thank you, everyone. It's great to be back. In the last, I guess, the last 7 weeks, we've done events in New York, Dallas, Geneva, Zurich, and mainly meeting with institutional investors, so hedge funds, mutual funds, pension funds. And we've been meeting with these large investors around the world, especially in the United States. And this presentation kind of gives you some of the feedback of some of the things we're learning in these travels around the world. One thing that's very clear is Scott Bessent is potentially going to be a major factor in the Trump U.S. Treasury team. And the Trump Federal Reserve, as we know, is already in place. But the Treasury team is coming together. And over the last 6 to 7 weeks, the Treasury team of the Trump administration, incoming Trump administration, has been leaking their agenda. And it's having a huge impact on asset prices. And it's kind of the opposite of 2016. It's a lot like 1980. In 1980, with Ronald Reagan, stocks were up almost 50% into the win, into the Reagan victory. And then on November 19th of 1980, stocks fell about 30% over the next year, and the market didn't get back to that same level for 2 years. In 2016, the Trump win was unexpected. But in the presentation today, I think one of the major takeaways is that this Trump win was widely expected by the professional investment community, the people that we spoke with, because of a whole bunch of different, very reliable indicators that are much better than polling data. But I think we'll kick it off with the first slide.
Sorry, the presentation is not showing at this time. It was, but then it was brought down.
Okay, I see the first slide now, but you can't see it?
No, it was before the main slide or the first slide, but now about maybe 3 minutes ago. You can't see it, or am I the only one who can't?
Yeah, I can see it. Yeah, private prisons.
Yep.
Okay, I cannot. Let me see. Maybe it's me. I'll take care of it. I'm sorry.
Okay. So, and thank you for your. I appreciate it. Anybody that can't see the presentation, please let us know. So one of the things that professional investors were looking at, and this is a classic Trump trade, the private prison stocks were going up into the election, and the solar names were going down. I think one of the best forward-looking ideas is because of the tax law situation in the United States, names are getting very, very cheap. And as you can see there, they're real. You can see before the election how the solar names, for a whole bunch of different reasons. The Democrats are very, very large ambassadors of solar energy. And in 2016 and 2008, the solar stocks ripped when Obama won. And I'm sorry, in 2020. In 2020 and 2008, solar stocks were up a ton when Biden won and when Obama won. But as you can see here, going into the election, the market had a very strong sense that Harris was going to lose. The solar stocks were, in sell mode. Meanwhile, private prisons, because of ICE and immigration rounding up immigrants and migrants, that private prison company clients have been talking about this for months. And as you can see, I guess the most important thing looking forward here, with tax law season in the solar names, you could get, I think, a really good buying opportunity over the next month in the solar names. And the reason I say that is the negativity is very, very, very overdone. Elon Musk, as everybody knows, has a big, large seat at the table in the White House. He's been in Mar-a-Lago for the last week. I hear they can't get him out of there. I mean, literally, he's in Mar-a-Lago. He's taking over a lot of the White House meetings. But at the end of the day, stake, not just in Tesla, but in battery technology, probably makes the TAN ETF a really attractive capitulation buy going to year end, because most likely the prognosis or the forward-looking visibility for the solar industry is probably much better than meets the eye. I think a lot of people are selling on fear. There's a lot of tax loss. What the tax loss policy in the United States, you could sell a stock in the fourth quarter and you can buy it back 31 days later and take that loss. So right now in the United States, because the market's up a lot, accountants are calling their clients and saying, find me losses. And people are selling losers aggressively. The solar names are big, large victims to tax loss selling right now. On the bright side, as you can see here, the banks, the regional banks, have been ripping higher. Alejandro Cifuentes at MMG has been. I talk to Alejandro all the time. He's been extremely bullish on the regional banks in the United States. I commend him for that. And one of his reasons was, if Trump wins, you bring in a deregulatory regime, and he was absolutely right. You could see in 2016 on the left that market was priced in that you could see that market priced in a lot of deregulatory relief. And the same thing, this chart was before the election. So what you want to think about going forward in elections in the United States, market-friendly candidates like a Trump, you will see dramatic outperformance ahead of the election from regional banks. They're a phenomenal leading indicator. The regional banks told us, as Alejandro Cifuentes made it very clear to me, that deregulation in the United States in a Trump regime is very bullish. And for weeks and weeks and weeks, the regional banks had been moving up into the election. So the regional banks were screaming at us, Trump's going to win. But a lot of people in the media were looking at the polls. All you had to do was just look at the regional banks. Now, this is important. You can see in 2016, when Trump won, the curve steepened dramatically. So this is the 2-year Treasury versus the 10-year Treasury. And over the last week, especially yesterday, we're really steepening quite a bit. We've steepened a lot over the last month. So as you can see there, once again, the market has been pricing in a Trump victory for a good while now. You want to think about the House, the Senate, and the White House are all in Republican hands. It is tight, though, in the House, and it's tight in the Senate. But typically, if one party has control of all three branches, that is typically upsetting to the bond markets. People will sell bonds, and they're worried about growth and higher yields. And so people will typically sell bonds into a candidate like Trump. And so Trump is scaring the bond market. As you can see here, the curve is steepening. Next one, please. Okay, give me 1 second. Okay, so this is the United Kingdom 10-year bond yield, and it's very important. The global bond market is selling off violently. It has something to do with the election, but it also has a lot to do with UK politics, the global bond market as a whole. So we have $2 trillion of fiscal deficit spending in the United States, 75 basis points of rate cuts, and a Trump victory, and it's scaring bonds globally. And as U.S. yields go higher, as you can see here, this is a Liz Truss moment. That Liz Truss stress point there in 2022 October. If this chart breaks, if yields on 10 years gilts, which is the UK bond, if those yields go higher, it's going to present a challenge for stocks, and it's probably going to have a contagion over to the United States. So you want to watch. Professional investors that we talk to are watching those UK bond yields right now. And as you can see here, it's not as bad in the United States. We're not through the higher yields there from 2022, but we are getting at very high stress levels. Remember, trillions of dollars of mortgage-backed securities, of commercial mortgage-backed securities, all kinds of bonds were sold to banks. Basically have those on their balance sheets. Mortgage-backed securities, treasuries, commercial mortgage-backed securities for commercial real estate. So there's well over $1 trillion of bonds on the bank balance sheet. And those bonds with higher interest rates are now trading at 60, 70, 80 cents on the dollar. And so this is a big threat to the banks. Right now, the banks aren't pricing in any interest rate risk. But if you can see in the chart, in the last 2 years, every time 10-year bond yields in the United States reached these levels, it was very, very, very stressful for the U.S. banking system. And right now, it looks like banks are appreciating the deregulatory regime that Alejandro Cifuentes, talked to me about in October and September and even August. That deregulatory regime from Trump is very bullish, but the interest rate risk that's coming at us is extremely bearish. So I think right now the U.S. financials are screaming sell relative to the incoming interest rate risk and the dollar risk, by the way. And so it looks to me like by this chart that we've priced in a lot of Trump goodwill on the deregulation side, as Alejandro Cifuentes warned us about. But now the interests on the U.S. debt and as interest rates go up, bond prices go down on bank balance sheets. So the banks are wearing a lot of bonds that are in the 50, 60, 70 cents on the dollar level, and that's going to create some major pain if bond yields go higher from here. Bond yields right now are a big threat to the market and to the banks. As you can see here, one of the things we talk about in our new book, How to Listen When Markets Speak, is there's about $15 trillion of debt that has come due in 2024, 25, and 26. That's $15.5 trillion. Janet Yellen has done a pretty evil thing, but a clever thing, but it's pretty evil. Janet Yellen's the United States Treasury Secretary, and what she's done is she's just issued $2 trillion plus of T-bills, and T-bills don't really move that much because they mature within 1 year. They don't move in price. A lot of that, the average weighted coupon on the U.S. Treasury portfolio is about 2.3, really more like 2.6% now, but the front end of the yield curve is 4.4. And so as those bonds mature, you've got a lot of bonds that are below 3% coupons in the 2.5 range, and they're maturing, and they're going to mature at 4%. And so this creates a huge stress point for the United States in probably January, February, in the first quarter. Many clients that we speak to around the world, more and more clients think, and all that means is it's a moment where the bond market breaks Washington and really puts a lot of pressure on politicians to cut spending. But the bond market, you're talking about $15.5 trillion maturing in 2024, 25, and 26. Those coupons on those bonds are 2.5%, 2.6%. The existing coupons in the market are more like 4%. So the interest on the debt is around 1 to 1.1 trillion now. And if as this debt rolls over, that interest could go up to 1.5, 1.6 trillion, and that's really going to break some things in Washington. This is a chart of gold, as you can see here. As real rates have gone up in recent weeks, violently, interest rates have gone up. It's putting some stress on gold. And we think gold here around the 100-day moving average is a great buying opportunity because it's, at the end of the day, higher bond yields, the dollar, they're going to break something in the coming months. So if you accumulate gold here into a violent reaction from the treasury yields going higher and the dollar going higher, we think is unsustainable. There's Microsoft and Apple combined have $360 billion of sales outside the United States. 360 billion. Those stocks are not acting well because the dollar strength is a big problem for companies that sell lots of products outside the United States. As the dollar goes up, it's really a wrecking ball for much of emerging markets, many companies. And as yields go up, that puts more stress on the financial system. And so we think as gold goes down, especially between the 100 and the 200-day moving average, as you can see here, it's the most on the RSI below the daily. You're coming into a real, almost screaming buying opportunity for gold. You want to kind of ease into it, but it's about a 9% drawdown now, and it's one of the largest drawdowns in the last couple of years. You want to try to buy gold between the 100 to 200-day moving average with all the problems in Washington that are still there. So as you can see here, so think about what's happened over the last 3 months. We have a Trump victory. The Federal Reserve has cut interest rates 75 basis points into an Atlanta Fed GDP that's been between 2.5% and 3.25%. So the Federal Reserve has cut interest rates. And that, once again, because that interest on the debt is so high, the Fed is panicked and they're cutting interest rates. And so that plus the Trump tariffs, Scott Bessent, as I mentioned earlier, is in that Trump treasury. He's been meeting with all kinds of hedge funds for the last couple of weeks, and they've been telegraphing this move on tariffs, and that's what's made the dollar really strong. But the downside of that is if they do aggressively tariff countries like the United Kingdom, like China, like Europe, if they use those aggressive tariffs, if you're Costco or Walmart, you're going to front run those tariffs. You're going to buy global products in size aggressively to try to get up front. So tariffs are extremely inflationary. And so the probability that we have another bounce, like a 2022 bounce in inflation, is high. It's not going to be as violent as 22, but the probability that we have a bounce in inflation is very high. And that is going to drive a lot of money out of stocks. Again, remember, right now the setup is very much like the fourth quarter of 21, when pretty much nobody expected inflation to rear its ugly head. And this is a chart of the, if you look back historically, inflation usually comes in at least 2, maybe 3 waves. And so we think that we're right on the precipice of a second wave of inflation. And once again, the federal government's running a $1.9 trillion deficit. We've cut interest rates 75 basis points. We have a China stimulus plan, and we have Trump and his staff that's promising all of these tariffs. Tariffs are very inflationary. So the probability that we have another bounce in inflation is very, very, very high. As you can see here, why is the Fed cutting rates aggressively? They're worried about that $80 billion a month of interest. And this is, your federal receipts versus outlays. As you can see there, we're at 80 billion a month of interest on the debt. 3-4 years ago, that number was less than 15, I guess that's 20 billion or so. So now we're up to 80 billion a month. And this is a big threat. And this is why clients are talking about a major threat to the bond market in the first quarter of next year. Okay, so what's happening in the market? Because of this greater threat of the bond market and inflation, and Trump is also pro crypto. So the crypto to gold ratio has made we're back in the zone, and we've been sharing this slide with clients for 3-4 years now. And our rule of thumb is when you get up near a 35, call it 30 to 36, 37 Bitcoin to gold ratio, it's a great time to sell Bitcoin and buy gold. And as a matter of fact, when you get down to a 10 to anywhere between 10 and 25 on the Bitcoin to gold ratio, it's been a really wise, very smart time to sell gold and buy Bitcoin. And this is a strategy that's worked for our clients since 2020-21. When you're long Bitcoin, always remember, when you're long Bitcoin, you are short U.S. equity volatility. And every single time in the last 5 years, every time the VIX has gone up above 20, 25 or so, you get a tremendous sell-off in Bitcoin. And so if you have big gains now in Bitcoin, we're recommending, especially during the Thanksgiving holiday where people sell volatility, we think that you should buy some volatility either through an ETF. The VIXY is one that we talk to clients about. But if you have big gains in Bitcoin, remember that you're short volatility, and you kind of want to hedge. You want to hedge those gains by buying some volatility against your Bitcoin. That's one of the things we're talking to clients about over the last couple of weeks. Next one. Okay, what else is happening in the market? Because remember, the 2010 to 2020 regime was low interest rates, low inflation. And in that world, in a low interest rate, low inflation world, financial assets, growth stocks do really well. As the world normalizes to a higher interest rate regime with a Trump administration, tariffs, and the dollar, higher inflation, higher bond yields, that brings money out of growth stocks and over to what we call hard assets. And so what you're seeing here is a rotation out of, say, the semiconductors, and money is going into the industrials. It's going into some value stocks. It's going into all kinds of different companies that are not in the technology space. Remember, this was the strongest growth sector all year, and now here we are. Advanced micro devices is below 2021 levels. We were lectured that we're in this artificial intelligence, new revolution, and there's a lot of companies in the semiconductor space that are below their 200-day moving average, and so the semiconductors are telling you that there's some type of rotation going on in the market, and we think that's because the market is fearful of a higher interest rate, higher inflation regime under Trump. And that's going to move money out of growth stocks. One of the things we're seeing clients buy is we're seeing clients shorting Walmart. We're seeing clients buying the 80-60 put spread 2-by-1 on Walmart. Walmart, during the trade war of 2018, Walmart equity dropped about 25%. And so Walmart is very vulnerable to a Trump trade war. We're seeing clients short Walmart. Walmart's trading at one of its highest levels above its 200-day moving average in the history of the company, and it's a victim of potential trade war with China. And so we're seeing some hedge fund clients starting to look for what we call U.S. dollar victims or trade war victims. The hedge funds that we talk to are looking at shorting companies that are exposed to the dollar or exposed to the trade war, the coming trade war, tariffs with China. Now, this is interesting. I mentioned a couple of minutes ago, there's kind of a rotation going on. As you can see, from 2010 to 2020, we were in a very strong disinflationary regime, okay? And now we've moved to a more inflationary regime since 2020. And what's fascinating about this chart, this is the Vanguard Industrials ETF, and it's been outperforming the NASDAQ since 2020, outperforming since July. And we argue, and we feel very passionate, that as interest rates and inflation normalize to a higher level, that money's going to move out of growth stocks and into value stocks, into industrials. And so, as you can see here, in that disinflationary regime from 2010 to 2020, every single year, the QQQ, what we call the NASDAQ 100, every single year it outperformed industrials. Ever since COVID, remember, never forget, the fiscal and monetary response to COVID and the regional bank crisis, so since 2020, has been $16 trillion. The fiscal and monetary response to the crash of Lehman Brothers, the financial crisis, was only $4 trillion. And so what's been happening is we've had this fiscal and monetary response to COVID and the regional bank crisis and the election coming up. Deficit spending this year, 2024, is close to $1.9 trillion. So you get a $16 trillion fiscal and monetary response since 2020, and that's basically triggering a massive migration of capital from your disinflation stocks over toward your inflation stocks. So once again, as inflation normalizes at a higher level with higher bond yields, capital is starting to move out of growth stocks over toward industrials. And so as you can see here, the Russell 2000, which are small caps, they moved up pretty aggressively after the Trump win in 2016. We noticed that since July, we've had an interesting top there in the NASDAQ versus the Russell. And we could see, once again, a rotation here. The one thing I worry about with this trade now is that the Russell 2000 companies, they're not strong balance sheets on some of the companies, so higher interest rates are a little bit of a headwind here. But at the end of the day, Trump, make America great again policies, whatever you want to call them. But the feeling is in 2016, you had a huge move up in the Russell 2000 relative to the NASDAQ. And a lot of people are trying to put that trade on now again. People think history is going to repeat. Next one, thanks. So one thing that I think is going to be a great opportunity for the fourth quarter this year, your materials and your energy stocks are under some substantial tax loss selling pressure. We love Weatherford here. We love oil services companies like Schlumberger, the OIH. These companies are under a lot of pressure with the strong dollar. And once again, the dollar's move higher is not sustainable because it's all tied to tariffs, and tariffs are inflationary, and that's going to break something pretty soon, but at least by year end. So never, ever forget. In 2016, I want you to remember this, talk about it at your coffee table tonight. In 2016, every single bank on the street told us, every single one, that the Donald Trump election would be a dollar positive. They said Trump wants a stronger dollar. But Trump and J.D. Vance, they were elected by the kind of middle class, working class people of America. That's the reason why Trump won the presidency, is for the first time since Reagan, the Republicans have been able to get a large amount of what we call middle class, working class people. The dollar is a wrecking ball in the Rust Belt. So states like Pennsylvania, Michigan, Wisconsin, these are states Trump won. So let's go back to 2016. They lectured us, the street research, Goldman Sachs, they all lectured us that Trump wanted a strong dollar. Lo and behold, first, second, maybe third week of January in 2016, Trump came out, started slamming the dollar, saying the dollar is hurting our workers. And next thing you know, over the next year and a half, the dollar was 18% lower into 2018. So I think the same thing's going to play out here. The dollar is getting really way, way overdone. And when that happens, materials and energy stocks get very, very cheap, especially with tax loss selling season, where Americans are trying to sell those stocks and buy them back in 31 days. This is going to set up a phenomenal buying opportunity for stocks like Weatherford, stocks like Schlumberger, OIH, XLE type names. Never forget, Buffett has been buying Occidental Petroleum, that's OXY. He's bought it above where it is now. I'm sure he's buying it today. He owns 250 million shares of Oxy. The stock is down a lot. Once again, it's a tax loss selling victim. It's a dollar victim. These trades are going to be really wonderful. I think fourth quarter buys as you get that capitulation at year end on tax loss selling. But by the middle of next year, Trump's team is going to do whatever they can to get that dollar down. And don't forget the midterms in 2026. Trump wants to get the dollar down by 2026 as well. So we think this is a great opportunity to get long some of these names going to year end. Okay, so we had a big move in the emerging markets versus the S&P, and now that's reversed. And so, as you can see here, it's similar to the materials and the energy stocks. The emerging market equities are going to be in a lot of pain in the fourth quarter with tax loss selling season and the strong dollar. And as you can see here, we're at one of the most extreme levels, but you're also seeing negative divergence here where the RSI isn't as strong down below. Anybody can reach out to Valentina at the beartrapsreport.com for these slides, or if you want an explanation of what we're talking about, it's Valentina at the beartrapsreport.com. But bottom line is the dollar is a global wrecking ball. The move is unsustainable. As you can see here, U.S. equities, once again, at all-time rich levels versus emerging market equities. This presents a buying opportunity for emerging markets going into year end. The dollar, once again. So right now, this is one of the most violent moves in the dollar in recent years. The 2021 into 22 move was more violent, but don't forget the Fed was hiking interest rates 550 basis points. So this move looks well overdone to us. You can see the RSI down the bottom. We're way overbought in the dollar. We think Trump in the first quarter really starts working the dollar a lot lower. But right now, once again, Scott Bessent and the Trump potential Treasury team has been talking up these tariffs. We know of multiple hedge funds that have been getting. This has all been leaked out of the incoming White House. They're sitting down with their hedge fund friends around the street, and a lot of people have front run this election. Like I said, it's a lot like 1980, where the market's up. In 1980, the market was up a lot into the election and then rolled over. This is similar today, where everybody's been front running this Trump trade. There was a lot of leading indicators that pointed toward a Trump win, and people have been front running this trade. So that's where the dollar is extremely overbought. It's going into year end. And we see a reversal over the next year and a half. Now, the strong dollar and higher rates, look at what's happening with new lows on the New York Stock Exchange. In the September, we were only at like 4, 5 to 10 new lows a day. Now we're hit 63 yesterday, and now 65 today. 60, we've basically gone from 50 to 65 over the last 3-4 days. So as you can see in the bottom right-hand corner, typically when you get a trend higher in new lows, breadth is deteriorating. That's a sign of potential pain ahead. The market's really overbought right now. We think we sell off pretty hard between now and say mid-January. Stress is coming at us, and those new lows on the New York Stock Exchange point to some stress ahead. Now, there are these trades out there that have been. This is why like you have to listen when markets speak, and that's our book is How to Listen When Markets Speak. But there's a lot of these trades that are Trump trades. As you can see, in 2016, the Fannie Preferreds were up violently when Trump won, and as you can see here in 2024, the Fannie Preferreds were going up, pretty sharply into the election. Once again, a lot of smart money knew Trump was going to win, and John Paulson, who's on Trump's team, owns most hedge fund people know that he owns a lot of Fannie preferreds, and so the market was front running the election here. Next one, and as you can see, this is a classic example of some of these Trump trades. About 50-60% of the good news was priced in going into the election, and now it looks almost fully priced. And we're seeing hedge funds sell some of these Trump trades now. We're not recommending Fannie Preferreds. We recommended them there at our London Ideas Dinner last year. One of our clients has been a very large holder of the Fannie Preferreds. We've been recommending them as a Trump trade in our work at the Bear Trap Support for the last 2-3 months. The Fannie Preferreds have been in our Bear Trap Support turning points on the weekends at least 6 times over the last, since June. And so the Fannie Preferreds are a well-known Trump trade. Right now, they look fully priced to us. If you did buy the Fannie Preferreds, we're recommending you sell at least half of them here. One of the interesting things about silver is in recent weeks going into the election, silver was one of the highest percentages above the 200-day moving average. But don't forget, in a real silver bull market, you can get 33 to 65, 75% above the 200-day. So we're recommending clients, because of solar, so the solar profile, because of the debt in the United States, silver is only a $1.5 trillion market relative to gold, $16.5 trillion. And we really like precious metals here. With as the dollar weakens over the next year, once again, the dollar move is unsustainable because it's bringing in much higher inflation, much higher interest rates because of inflation. And the bond market's going to break Washington. When that happens, you want to be long gold and silver. And so we recommend, buying the dips. I mean, silver's been very strong all year. It's down a lot. And as you can see here, it was very, very overbought. And now it's getting very, very attractive once again. Palladium, remember the automobiles in the United States, the hybrids, there's been a big revolution of hybrid technology coming into electric vehicles, and hybrids have catalytic converters. And so there's a lot of clients that we have seen that have been buying palladium. It made a beautiful move in recent weeks, and now it's coming back down. We think commodities like palladium are going to be a real buy here in the fourth quarter. And, you've got a really nice long-term, what we call, deep capitulation trade here, where palladium's really washed out. And you're going to get some selling also toward year end with the stronger dollar. We think you want to use that opportunity to buy metals like palladium for a whole bunch of different reasons, which we can get into in the Bear Trap report. But I think that's it. That's a look at our presentation, and we thank you very much. Valentina at the beartrapsreport.com if you want to follow up and get on our reports. I'm happy to catch up now with questions or in the future.
Thank you very much, Larry, for sharing us your insights and your expertise. We now open the floor for any questions for the audience. If everyone has a question, please feel free to ask. Abrimos ahora un espacio para preguntas del público. Si alguien tiene alguna inquietud, puede hacer la pregunta, no sé si quiere mediante el micrófono o escrita en el chat.
There has to be one question.
Probably people are thinking.
Well, I missed the first part. Oh, they're thinking.
Probably people are thinking about maybe the question.
Well, I guess the most important question is the dollar. And if the dollar rips here in a year end because Scott Bessent and the Treasury team has been leaking their agenda, and they've been leaking it for 6, 7, 8 weeks now, it's going to present a big potential problem for EM, for Panama. Remember that strong dollar makes everything in Panama more expensive, right, to global investors. So it hurts tourism. And I think Panama needs a weaker dollar. But I know a lot of emerging market countries that are not happy with a strong dollar. If you're a Brazil trucking company, you're paying a much higher price for oil in dollars now, because oil's priced in dollars.
I do have a question. Now that there are some metrics that you're looking at, probably some inflation measures are kind of pointing a little bit upwards lately. And you have maybe a weakening, or some measures are a weakening labor market, which would be considered maybe the initials of stagflation, which obviously we're very far from that. But what would be your take on what we're looking at, and what is the Trump administration? What are the weapons that they would have if we see these measures worsening?
Okay, so one of my favorite lines is from the famous hockey player Wayne Gretzky. And Gretzky used to say, I like to skate to where the puck's going, not skate to where it's been, right? And so one of the things we want to do looking forward is think about, okay, next year with the dollar, and just think about inflation. Think about Trump taking 500,000 people out of the United States. That puts all of the, right now, immigration has been keeping inflation lower, right? And so if Trump takes cheap labor out of the United States, all it's going to do is increase inflation, right? Same thing with tariffs. The tariff thing looks great on a chalkboard, because when you talk to Republicans, they're like, oh, we're going to bring in so much tax revenue. We're going to bring jobs back to the United States with tariffs. The problem is people will try to front run tariffs. Tariffs are very inflationary. And then you have tax cuts. Tax cuts are also inflationary. And then you have the $1 trillion that Biden spent over the last, Biden team spent over the last year and a half, the $2 trillion. And then you have the China stimulus. So the whole thing points toward a big bounce in inflation next year. And Trump's policies, unfortunately, are pretty inflationary, even though but what they'll do is they'll just blame the whole thing on Biden and Harris. And then, because what they want to do is really take the pain. They know they need to take the pain early with tariffs, and then they hope over time, over the course of 4 years, they'll be in a much better spot after the pain.
Bueno, si no hay más preguntas, agradecemos a todos por acompañarnos. A Larry nuevamente por su tiempo. Gracias, Larry. Thank you, Larry.
Thank you
Y
very much.
esperamos que Thanks. Esperamos que este conversatorio haya sido enriquecedor para todos ustedes y nos vemos en una próxima ocasión.